You ever see an investment number that's so big you just have to stop and stare for a second? Well, today we're looking at OCCI, a company with a dividend yield that honestly seems almost unbelievable. So the big question is, where is all that money coming from? And, what's the catch? Let's dive in and break it down.
And this is the number that stops everyone in their tracks, about 20.8%. I mean, to put that into perspective, most income investors get pretty excited about 5, maybe 6%. This is nearly 4 times that. For anyone who's trying to generate cash from their portfolio, a number like this, well, it's pretty much impossible to ignore.
And yeah, that brings us right to the fundamental question, doesn't it? Is this some kind of incredible overlooked opportunity that everyone's missing? Or is it a classic case of, if it sounds too good to be true, it probably is? That's the exact dilemma we're going to unpack right now.
Okay, so to understand that massive yield, we have to pop the hood and look at the engine, because OCCI isn't your normal everyday company. It's a very specialized, very powerful financial machine. Let's see how it's actually built to crank out so much income. So at its heart, OCCI, that's OFS Credit Company, isn't a typical stock. It doesn't make widgets or sell software. Instead, its entire business, its whole reason for being, is built around owning and managing pieces of these really complex financial instruments called collateralized loan obligations, or CLOs for short. And when I say they focus on CLOs, I mean they are all in. Just look at this chart. Over 94% of their entire portfolio is invested in one very specific slice of the CLO world, something called CLO equity. This isn't just a focus, it's a laser beam concentration. And that single choice is the reason for both the gigantic reward and the gigantic risk. So what in the world is this CLO equity? Okay, picture a giant waterfall of cash that's being generated by a huge pool of business loans. Now, the super safe investors, they're at the very top of the waterfall. They get paid first, no matter what. It's a steady, predictable stream. The CLO equity tranche, it's sitting at the very bottom. It gets to collect everything that's left over, which can be a massive flood of cash. But, and this is a huge but, if any of those loans start to go bad, the waterfall starts to dry up from the bottom first. The equity tranche is the first one to take a hit. It is the definition of high risk, high reward. And this brings us to the core conflict, right? The double-edged sword of OCCI's whole strategy. That huge yield, it doesn't come from nowhere. It comes with a very real, very measurable cost, which we can actually see in the company's own numbers. Here's the reward side. Here's the good stuff. OCCI pays out a monthly cash distribution to its shareholders, and it adds up to 60 cents per share over a whole year. Based on its recent stock price, this is what creates that eye-popping 20+% yield. It's real cash paid into your account. But here's the other side of that sword. This chart shows what's been happening to OCCI's net asset value, or NAV. Simply put, NAV is what the company's investments are actually worth. It's the underlying value. And as you can plainly see, that value has been going down, and fast. We're talking a drop from over $5 a share to around $4 in just 4 months. And that, right there, is the crucial trade-off. You're collecting this huge stream of income, but the actual value of what you own is shrinking. So the big question for any investor becomes, is the cash you're getting paid coming in fast enough to make up for the value that's literally draining out of the company? Now, this isn't happening by accident. This whole dynamic is a direct result of the company's management team following a very deliberate, very high-risk, high-reward strategy. Let's break down how their game plan creates these exact numbers. This little table really tells the whole story. Look at that top line. The company generated 32 cents per share in actual cash income. Cool. That's the money that funds the dividend. But then look at the line right below it. Unrealized depreciation. That's just a fancy way of saying the market value of all the stuff they own went down. So even though they collected a bunch of cash, the value of their assets on paper fell by 94 cents. You do the math, and what do you get? A total net loss. And that's exactly why the net asset value we just saw keeps dropping. So here's the game plan, laid out in 3 steps. First, they target only that super high-risk, high-yield CLO equity we talked about. Second, they use leverage, which is basically just borrowed money. Think of it like a magnifying glass. It makes the income stream from their investments even bigger, but it also magnifies any losses just as much. Third, they're constantly taking the cash they earn and reinvesting it into new high-yield deals. The entire strategy is designed for one thing and one thing only: maximizing the cash flow. Okay, so we've seen how the engine works. We've looked at the numbers. Now let's just step back and put it all together. What's the final verdict here on this pretty unique risk and reward setup?
The risks here are not exactly hidden. That NAV erosion we've been talking about, it's a persistent problem. The CLO market itself is super sensitive to what's happening in the economy. That leverage we mentioned, it cuts both ways, big time. And it's all concentrated in one single risky asset class. And maybe most important of all, that huge dividend payment, it is not guaranteed. In fact, they recently reduced it to the level it's at now. So who is this actually for? You don't have to guess. The company tells you themselves, and it's probably worth listening. Their own report says this is, quote, suitable for sophisticated, high-risk tolerant investors. In other words, this is not a buy it and forget about it kind of investment. It's built for a very specific type of person who fully understands and is okay with all the pretty significant risks we've just covered. And that really brings us to the final question, the one that truly matters most, because it's at the heart of the whole OCCI deal. It forces you to ask yourself, for my own financial goals, what am I really trying to do? Am I prioritizing a high stream of cash that I can get today, or am I focused on the underlying value of my investment growing, or at the very least staying stable for tomorrow? There's no single right answer for everyone, but it is the question you absolutely have to answer before you'd ever consider an investment like this.